Good morning. Welcome to the SERINUS Energy PLC Q3 2024 investor presentation. Throughout this recorded meeting, investors are being listen-only mode. Questions are encouraged, could be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jeffrey Ault, CEO. Good morning, sir.
Good morning, thank you. Well, thanks everyone. Welcome to the SERINUS Energy PLC results presentation for the 9 months ended 30th of September 2024. I'm joined today, as usual, with Stuart Morrison, our COO, Vlad Ryabov, our CFO, and Calvin Brackman, our Vice President of External Relations and Strategy. As a quick overview, SERINUS has two operating areas, Romania and Tunisia. Both are large concession areas. Romania is where we found, discovered, and developed the Satu Mare Moftino gas plant. That gas plant is, as we've said in previous presentations, at the end of its, the field is at the end of its natural life. It's still producing. The production there is steady, but it's down to its last production of gas. So Romania now is focused for an exploration area to find a new Moftino and to repeat that development. Tunisia, two concessions, Sabrija and Shuesha. Sabrija is owned 45% by SERINUS. Our partner is the government state oil company, ETAP. That's a very large field that needs development capital. There's 445 million barrels in place. A very, very low percentage of that has been produced. Shuesha is down in the very far south. That's 100% owned by SERINUS. That's where we put artificial lift in. The pumps there are working as we expected. We've just had to replace 2 pumps in this quarter. Those pumps outlived our expectation. They lasted just under 4 years. So both of those pumps, 2 pumps have been replaced with new pumps. We had an inventory. So 2 workovers were performed in this quarter to keep the production up. Those 2 blocks, those 2 concession areas give us lots of investment opportunities. So the question is not options, the question is the capital to exercise those options. And that's what our production is designed to provide. During the period we did our lifting, I think at our last results meeting we announced the lifting was coming up. A few days after our last results, we managed to get a price of $78 for that lifting. So commodity prices definitely fallen, but we lifted 50,000 barrels in August at about $78 a barrel. Company remains debt-free, and all of our cash flow right now is being accrued for the W1 sidetrack, which I'll talk about in a little bit. Our valuation, we're valued at about 70 cents a barrel of oil of 2P reserves. Our reserve life is 28.5 years. Sector average for 2P reserves is $3.82. So we believe our reserves are significantly undervalued. Cost control is very, very important as we try to accrue capital for the W1 sidetrack. So we keep cash very tight. At the 15th of November, we had $1.8 million in cash. So we're accruing for the cash, accruing for the W1, whilst keeping things like the workovers for the pumps and Shuesh, maintenance capital, and G&A. Like I said, they're both 2 large concession areas. The proved reserves on Romania, proved and probable, are low because we've exhausted the Moftino gas field. We'd look to be repeating that. And then we have high reserves and certainly a lot of resources sitting in Tunisia, where W1, we anticipate the first pump is the way to start developing that resource and have those reserves. Production for the period, we had 577 barrels of oil a day. During the period, that's 157,521 barrels. Romania, as I said, end of its natural life, 55 barrels a day. And Tunisia's 522 barrels a day. We were down a little bit in the quarter while we took those wells offline to replace the pumps. Pump installation was done under budget, on time. 2 pumps. We had the pumps in inventory. Pumps previously were lasting about 8 months, so they were just barely making payout. These pumps lasted, like I said, just under 4 years. We're over 36 months on each pump. The economics of the pumps are very good. So getting the pumps in there, increasing the production is a good indicator of what we think we can do with the sidetrack and the pump installation in W1. Everyone's waiting for the W1 well, including us. We have all the long lead items in the country. We've got the rig. The rig is right now on a ferry out to Card Island for Parenco. They'll drill 2 wells. We understand that they'll drill 2 wells. We don't know how deep or how long those wells will take. And then after that in the queue is Mazarine. And then it's us. We had hoped to get this rig the end of this year. The rig was in for maintenance and certification, which is a good thing. Getting a recently maintained and certified rig on site is a great thing, but that took longer than expected. So it's been handed over to Parenco, and it's now into its drilling program. So we have the rig available. We're in the queue. The contracts are all signed. It's just, and all long leading items are there. It's just waiting for that rig to become available. Once we get that rig, we'll perform the sidetrack, and people will remember that we're going to have to go around a lot of junk in the hole to get down to a clean portion of the hole where we can install the pump. So that's all planned. That's all ready to go. Just waiting on that rig. And that has been, I think, for everyone, very frustrating, the time it's taken the rig. I'll remind everyone there's a national drilling company. There's not a lot of rigs in the country. We have a specific rig that we want to use. It's done a good job for us before, and like I said, it's recently recertified, and it's just had its maintenance. So it's in good shape, ready to go as soon as we can get it. Romania has just is in the midst of its presidential elections right now, so a lot of the communications with the Romanian government is very sparse while they're going through their election cycle. It looks like a more business-friendly political party will be elected. That party has made part of its platform the reinvigoration of the Romanian oil and gas industry, which we'd be eager to see. And hopefully that December 1st, I think, is the second date for the presidential election. And then we'll have some political unfreezing where we'll be able to get back to work there. We'd like to do 2D seismic on about 100 kilometers over some of our next targets. So once we acquire that seismic, we'd be anticipating back to drilling in Romania. You'll recall that the wells in Romania are much cheaper than they are in Tunisia. So in Moftino, we were drilling wells fully completed and tied in for about $2 million. So these are good wells when you can get them tied in. And of course, we have a gas plant sitting there waiting for more gas. So infrastructure-wise, our targets are close to the national transportation system, and we'd like to get on with these targets. We've spent the time in Romania reviewing a lot of the technical data, a lot of the data from our previous wells, both the successful Moftino wells and the Canar and the Moftino Nord well, which were not successful, to determine exactly where our next best targets are. The Canar 1 well was drilled as an exploration well. It found gas, but not in sufficient quantities to produce. That was then converted to a water injection well. So far this year, that's saved us $432,000 in water disposal costs. So the well has paid itself back, but not in the manner that we had hoped. So that's a good water injection well and can be used in the future. I'll hand it over to Vlad. Vlad, you want to run through the financial highlights for the year or
Sure.
for the period?
Yeah, sure. Thank you, Jeffrey. Looking at key highlights of our financial performance for the first 9 months of 2024, revenue came in at 12.2 million, slightly below the same period of 2023, where revenue was 13.3 million. The decrease is driven by production and commodity prices and analyzed later in this presentation on next slides. Gross profit, however, remained stable at 1.8 million, which is consistent with the prior period. EBITDA saw a notable improvement, increasing to 1.9 million from 1.2 million in the same period of 2023. Funds generated from operations also improved to 1.9 million, a significant growth compared to the same period of 2023. General and administrative expenses decreased to 2.5 million from 4 million in the same period of 2023. Again, as Jeffrey mentioned, this demonstrates our continued focus on cost optimization and cost controls, which we've got in place throughout the group. Net loss narrowed to 2.6 million, a meaningful improvement from 4.6 million loss recorded in the same period of 2023. Our capital expenditures totaled $900,000, all of which were incurred in Tunisia, reflecting disciplined investments in our core assets. Looking at our pricing and netbacks for the first 9 months of 2024, we realized a net price of $74.24 per barrel of oil equivalent. That is up from $76.84 in the same period of 2023. This includes an average realized price of oil of $81.52 per barrel, an improvement from $78.68 in the same period of prior year, and a natural gas price of $11.19 per MCF, slightly down from $12 in the same period of last year. The group's operating netback averaged $29.82 per barrel of oil equivalent compared to $34.15 in the same period of 2023. Breaking this down by region, Romania recorded a negative operating netback of $43.24 per barrel of oil equivalent, and Tunisian operating netback was very healthy and comprised $36.39 per barrel of oil equivalent. And lastly, as Jeffrey mentioned previously, our cash balance was 1.3 million as of 30th of September 2024. And by 15th of November, this had improved to 1.8 million, reflecting on our efforts to strengthen our cash flow management and cost controls. Here we've got the breakdown of our financial results for the first 9 months of 2024. Revenue, as I mentioned earlier, was 12.2 million. That is down from 13.3 million in the comparative period of 2023. This decline was driven by lower production volumes in Romania, though partially offset by higher realized oil prices in Tunisia. Cost of sales decreased to 10.3 million compared to 11.5 million in the same period of 2023. This reduction reflects lower windfall tax and depletion in Romania, and that is more than offset slightly higher operating expenses and royalties. Gross profit remained consistent at 1.8 million, mirroring performance in the first months of 2023. Finally, the net loss for the period improved to 2.6 million, a significant reduction from 4.6 million loss recorded in the same period of 2023, highlighting our ongoing efforts to manage costs efficiently and improve bottom line performance despite production challenges in Romania. Looking at production and pricing for the first months of 2024, our overall production averaged 577 barrels of oil equivalent per day. Romania contributed 55 barrels of oil equivalent per day, reflecting natural declines as only one well remains in production and 2 wells are awaiting recompletion to access untapped volumes behind pipe. Tunisia maintained steady production at 522 barrels per day, supported by our workover program and effective reservoir management. Our pricing at the group's average the group's average realized price was $78.24 per barrel of oil equivalent. The increase was driven compared to the prior year, was driven by the higher realized oil prices, which have set lower gas prices in Romania. In Romania, the average gas price was $9.85 per MCF, and in Tunisia, the average crude oil price was $81.52 per barrel. Reviewing our production expenses and operating netbacks for the first nine months of 2024, total production expenses on the level of prior period, and they totaled $6 million for the first 9 months of 2024. Tunisia accounted for 4.7 million of this total, and Romania's production expenses comprised 1.3 million. Again, reflecting on the challenges of maintaining production with only one well active. On a unit basis, production expenses averaged $38.70 per barrel of oil equivalent. Tunisia's production expenses were $33.22 per barrel of oil equivalent, demonstrating cost efficiency throughout that business unit. And Romania's expenses were significantly higher, reflecting the reduced production volumes in Romania. On our operating netback, averaged $29.82 per barrel of oil equivalents, impacted by lower gas prices and volumes in Romania. In Tunisia, the operating netback was strong and healthy at $36.39 per barrel of oil equivalent, supported by higher oil prices. And in Romania, the operating netback was negative at $43.24 per barrel of oil equivalent, underlining the challenges posed by the reduced production and lower realized gas prices. Group capital expenditure stood at $900,000 and was all invested in Tunisia in preparation for the Sabriya W1 well sidetrack and artificial lift targeted for the second quarter of 2025. The group generated 1.9 million of funds from operations for the 9 months ended September 30th, 2024. Breaking this down, Tunisia contributed a robust 4.8 million, driven by steady production levels and achieved realized oil prices. Romania recorded a net spend of $600,000, reflecting the impact of reduced production and lower realized gas prices. At the corporate level, our G&A, or general and administrative expenses, comprised 2.3 million, decreasing from 4 million reported in the same period of 2023. Again, this highlights our ongoing commitment to optimizing corporate costs and overheads and maintaining strict control over costs and cash flow management. With all of the above, our EBITDA sums up to 1.9 million for the first 9 months of 2024.
Stuart, you want to run through the environmental and safety side?
Yeah, certainly, Jeff. Well, we continue to focus on environment and safety and continue to have a good track record on both of those. We're really proud of our record in Tunisia and Romania, and we continue to put work in to make sure that goes on. The Boftina gas plant is still an excellent gas plant, produces well, and the fugitive emissions are minimal because of the design, and we continue to monitor those on an annual basis. In Tunisia, we keep looking at the environmental monitoring, which we exceed the statutory requirements, and we keep an eye on it by third-party inspections, which we've maintained for a number of years and continue to do so.
Okay. So in summary, cash flow from Tunisia remains strong. Romania production is, has declined to a minimal level. We have fixed costs in Romania to keep the gas plant running, to keep the operations going, and to keep what is essentially now an exploration office open. The large asset base does offer us a lot of opportunities. Those opportunities have been the same that we've had, and it's a matter of getting capital to do them. And that takes some time to accrue the capital. The existing production funds the core business and our near-term plans. We would like that to move faster, but we're right now waiting on that rig for W1. So the big plans are still focused on the W1 sidetrack. We have previously talked about how material we think getting a pump into the Sabriya field can be. Our partner wants us to put a pump in before we start a broader pump program. So we have to get that W1 pump in before we can go off to some of the bigger wells, specifically the Win 12 well. We think that artificial lift in that is a real game changer. But again, that would be dependent upon getting the W1 done and then getting in the queue for the rig again. In Romania, we've spent a lot of time on a block-wide geological and geophysical study to devise the next targets and to lay out the seismic program. That's the 100 kilometers of 2D seismic over those prospects. And then we'd like to be able to get on with that. So there is long-term exploration opportunities. We've talked before about the gas that we believe underlies the Schwesh fields. That's the same structure that the OMV Nawara project produces gas out of. And we think deep below our Schwesh oil prospects, all our gas prospects, that now that Nawara is up and running, that becomes commercially manageable. So right now, it continues to be a focus on costs, making sure that every penny that we have can go towards W1. And as soon as that's done, we expect the higher production and the cost, the revenue from that to go towards our further programs. So the plan remains the same, delayed by the access to the rig in Tunisia. And that is our presentation for the 9 months ending 30th of September 2024.
Fantastic. Thank you very much indeed. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab just on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've had a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Jeffrey, if I may just ask you to click on that Q&A tab, where appropriate to do so, if you could just read out the question, give your response or direct it to the team, and I'll pick up from you at the end.
Sure. First question, what would be the message to long-term investors in London who believed in Mr. Alt's vision for the future since the IPO on you? The vision has remained the same. The assets, we have the same assets that we did when we moved the company out of Canada to London. We drilled 2 wells. We developed and produced Moftino, and then we drilled 2 wells that were designed to augment the production of Moftino. Those wells were disappointing in that they found gas, but not sufficient quantities to be economic. In Tunisia, we have very clear plans to develop the Sabria field. It's a very obvious field to develop. 445 million barrels in place. 1.6% of it has been produced. There's lots of oil to produce there. The issue for us is accruing capital to do that. We've said that we want to use internally generated cash flow. That has been a very, very long, slow, and painful process. Getting a rig, getting the long lead items before we could contract for a rig. We couldn't contract for a rig until we had items in country, simply because if we contracted a rig and we didn't have a critical piece of equipment, when the rig showed up and we're unable to drill it, we would then be paying rig rates for a well that we could not drill because we didn't have the long lead items. Getting the long lead items took a while. That was partly due to Tunisia, partly due to supply chains right after the pandemic when we started looking at this, and partly due to the time it took us to properly design a sidetrack. So it's been a lot slower than anyone had wanted, but the assets are the same. The assets provide plenty of optionality, and it's a matter of accruing cash to get on with those. So the vision is the same. These are good assets. These have plenty of opportunity on them, and it's a matter of the company getting the capital to execute on them. Apart from the next question, apart from the statutory update releases, communications with investors practically does not exist. What is the director's plan to bring PR standards to a more respectable public company level? Well, I take issue to that. We quarterly have these results when people are able to ask questions. We have always maintained availability. So if people want to contact us, we're happy to talk about things that we can talk about. We will, if there's something that materially changes in the business or is price sensitive to the share price, we will release that immediately without delay, and we have done that. And we're always available to discuss what the plans are. While we're sitting in accruing cash flow, we're not operationally active right now. So there's very little to be said outside of our quarterly results, where we report on the results, the important financial results of the company. We are available. Our contacts are at the end of every presentation, and we would encourage you to reach out to us if you have a specific question. We'll answer it if we can. Recent developments involving the main shareholder paying directors' taxes and getting cheap shares in the process isn't such a procedure against retail investors' interests. I think this refers to the recent exercise by employees and management of our long-term incentive plan shares. It is very, very common that the company and our long-term incentive plan was approved by shareholders. The company grants long-term incentive plan shares to its staff. Those staff can then exercise those, and rather than create a tax event for our staff, the company takes the taxable portion of those shares, which are taxed as salary for everyone. The broker then places those shares in the market. We're not aware of where the broker places them. We find out where they've been placed. If a major shareholder releases a TR1, we find that out at the same time as everyone else does. So what happens is the company issues the shares to the employees. The employees pass the taxable portion of those shares to our broker, who places them in the market. The money from the broker comes back to the company, and the company pays the taxes on behalf of the employees. So isn't that against retail investors' interests? No, that's an incentive program that's just like salary for our staff. Next question, how do you look to work to extract the 400 million barrels of oil? It's a huge resource base. Could you create funding package with the government to maximize this for you and the government by developing it with them? Well, the government is our partner in Sabria where those reserves exist. And so the government is in the same position that we are, waiting on that rig. The government drilling company is a different company than ETAP. And we are in the same queue that everyone else has to be in. It's difficult. We wish there was a lot more rigs in the country. But the government is in exactly the same position. We are prepared to fund the W1. They're ready to go. We're all eager to go. We're all approved on the plans. It's just a matter of waiting for the rig, which the government in the form of ETAP, our partner, has to wait for the same rig that we have to wait for. So this isn't a matter that if we went to the government and said, funding, can we get some funding to do this? No, this is waiting for a rig. Now, if we had more funding, we would be in a different position because we have a one well program, and clearly from a drilling company, the companies that are ahead of us have multiple well programs, so it's more valuable for the drilling company to do that. Saying that, we're in the queue. We're not going to be bumped from the queue. But if we had a 4-well drilling program, we'd be far more attractive to a drilling company, and we would be able to access both long lead items faster and the rigs faster. So yeah, there is a funding issue that we're funding this out of operating cash flow. If we were able to accelerate that and have more funding, then yes, we could move faster. But it's not a question of the government wanting to maximize this. I think the government in Tunisia is eager to try to get their oil and gas industry back up to the standards it was sort of 5 years ago. So they're actively trying to find ways to increase production, and we're one of those. Politically, it's been Tunisia went through a presidential election a couple of months ago. There's still not the institutional bodies in place for a sort of a top-down communication. So it's still hard to get communication through to the right place. But that's not an issue for what we're waiting for now. The issue we're waiting for right now is simply waiting on that rig with the government. Then there's a question, could at least half of the VAT refund be paid as a dividend to long-suffering investors? Well, we have a court case, as people know, the Romanian government has failed to redeem VAT. We won a case last year. We won in court. The Romanian tax authorities have a statutory right to an appeal. They've filed that appeal at the last day available to file the appeal. They have given no grounds to appeal. They don't have to. And the court case for that is coming up in February. We expect to prevail. And then, once we prevail, we'll decide what the funds do. But share buybacks, dividends, right now the opportunities on the ground are sufficient that we would likely apply that capital to operations to continue to try to grow the business. When we have grown the business, like with Moftino, like with Schwesh, they've been successful and they've been good returns. So likely we would take a look at what happens in the court case. I think it's premature to judge the court case right now, but in the event that we prevailed, which we do expect to, then we'll determine what we would do with that funds. Remember, those funds were expected into the company back in February of this year, and so that has been that was built into our capital plans, and we've been surviving without it. Once those funds, if we prevail in the court case, are redeemed to the company, then we'll have to decide what we do. Has there been any company contact with Extelis? Extelis is a big shareholder. Extelis, I've reached out to them, they've reached out to us, and yes, we've had contacts. We talk to them as we do with any shareholder. They are not privy to anything that other shareholders are not. I've talked them through what our aspirations are in the business. They have taken a look at those and continue to be a buyer, or have continued to be a buyer. I don't know what they are right now. I have no insights into their aspirations, but like any shareholder, we communicate with them frequently. And I think that's, let me just scroll down, make sure we've got, and I think that is, sorry, is it anticipated that the lifting in December will be similar size to the recent lifting? Yeah, the lifting will be a little bit lower because it's a shorter accumulation period. Prices are down. We managed to get just over $80 in our last lifting because we had a Saharan differential. Our crude is a light, very light crude, so we had a Saharan differential that put us above $80. Oil prices right now, I think people are more cautious about the future of the oil price. I'm hoping through the accumulation period we get a good price. But of course, we've seen a lot of volatility in the oil price. So trying to predict what the price will price at is difficult right now. But you know, we all have screens. We can see what the oil price is. I think with the Saharan differential, we should be a good price. But oil price is you know, it's very dynamic right now. Done well keeping Tunisian production flat year on year with limited investment. How do you see Tunisian production performing in 2025? Well, the big thing for Tunisian production in 2025 is getting that W1 sidetrack on. And so the earlier we do that, the better the 2025 will look. We have said that we think that a pump in there can increase production by about 400 barrels a day. So that is, you know, that's an important one. And if that was to happen, then clearly production would be quite a bit higher. As for our organic production as it stands right now, Tunisian production is stable. We were down a little bit this quarter when we did the 2 workovers, but it's pretty stable and we can keep it going. We don't want to just keep it going. We would like to increase that. W1 is the real target. After the 2 wells for Perenco, how many wells is the rig committed to for before it comes to SERINUS? Well, we don't know for sure, but we know that we understand that there are 2 wells for Perenco, and then there's 2 wells for Mazarine. So some of those wells may be contingent wells, we don't know. So if all of those wells are drilled, then there's 4 wells ahead of us. Given the recent exit or merger of several London-listed E&P companies, how do you consider these strategic options? Look, I've made no secret. I think that valuations of ourselves and valuations of a lot of AIM oil and gas companies is very, very low. And I think those are the environment where things happen. Have we looked at M&A? Have we looked at acquiring things? Yes, we've looked at a lot of different things. Those would require an allocation of capital or equity capital. And right now we view that the opportunities we have in our own portfolio are more attractive than things we've looked at, even at the significant discounts. But there is a shrinking oil and gas, junior oil and gas pool on AIM specifically, and those valuations are very, very low. Would we look at opportunities to change the business? Yeah, I mean, I think that's what we do. We have looked at M&A and we have looked at acquisitions of assets, and nothing. Well, we found things, but these are always, they take time and they're hard to negotiate. But we would look at things like that. What is happening with the Sabrina N2 well? Well, the Sabrina N2 well is gradually dewatering itself. Our partner has not approved us to acid wash and solvent wash that well, which we believe would speed up the dewatering and get us to oil production. They haven't approved it. We can only suspect why they haven't approved it. I don't speak for ETAP, but they have a big capital program. There's lots of things that they want to do, and I suspect that it's just down on their list of things they want to do. And that means that without their approval, we have no way of going ahead and doing what we think should be done. What we think we should have done weeks after that well started displaying this performance. We had immediately planned for an acid wash and a solvent wash on that well, and immediately submitted it to the partners when the results started coming in. So it's been frustrating, but without partner approval, without our partner who owns 55% of it wanting to do it, and I just believe it's low on their capital allocation list, that is going to dewater very slowly. So it's an opportunity that sits there that we would like to speed up, but we do not have partner approval. We continue to discuss this with them, try to convince them that we could do this. Is capital the constraint for growth? And if so, would the company consider debt capital to accelerate returns? Yes, capital is a constraint for growth in that we have the programs we would like to do, and we need to wait for the capital to accrue within the business to be able to do it. If we had more capital, we could move more quickly. It's simple as that. Would we consider debt? We would, but I mean, debt costs are very high right now with our equity where it is. It doesn't look very attractive when you look at the cost of it. So the balance here is the time it takes for us to accrue the capital versus the cost of accelerating that. And that is always a difficult balance. Let me just. And lastly, I think the last one here, W1, could you remind me of the expected uplift? Stuart, do you have the expected uplift there?
Yeah. On a gross basis, 100% working interest basis, it would be just under 800 BOE per day. So net our share, 350 to 400.
Yeah, that's from the SGS report that we had done to design the artificial lift program. So that's a third-party number. So 350 to 400 is the uplift. It's a net to us. It's a considerable uplift. And putting a pump in a field that's never had pumps before, you would hope to get a big uplift like that. So this is a very, very critical well for us, and it's been critical since when we first went into that well. It is frustrating having a prize like that out there and not be able to get to it because we're in a queue. But that's the expected uplift as published, as provided by a third party artificial lift design study that we had done. And I think that is the end of our questions for today.
Jeffrey, thank you very much indeed, and thank you to the team for updating investors today and taking all those questions. And of course, any further questions that come in, the team will have the ability to review all of those, and we can publish responses where appropriate to do so. Before redirecting investors to provide their feedback, which knows particularly important to the team. Jeffrey, if I just ask you for a few closing comments, please.
Yeah, well, look, I mean, I think the quarter or the period has been a stable period. We've managed to cut costs as much as we can to get ready for, accrue as much capital as we can for W1. It is very frustrating sitting waiting on a rig. I understand that. There's very little we can do. We've actually tried to see if we could get rigs into the country, but that's not going to work. And then having a rig go in for maintenance and certification, and that took longer than expected. This is very frustrating. We would like to get on with this. We would like to get on with this. When we realized we would have to do a sidetrack, we realized it was going to take time. We've given the best estimates we can, but a lot of the time and control rests with others that we can't control. So we are in the queue. The rig is contracted. All the long lead items are there. We are ready to go. It's just a matter of getting the rig. So I understand the frustration. I understand this has taken a lot longer than people had hoped. It's a lot longer than we had hoped. But there is a nice prize out there, and so we're working towards that prize. Thank you.
Fantastic. Thank you very much indeed. Thank you to Jeffrey, to you and the team. Can I please ask investors not to close the session, to be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.